It's probably not that much. Our estimate of how much accommodation there is has come down over time as economists have reconsidered what is a neutral stance of policy. But nevertheless, there is accommodation. And while there's no fixed timetable for removing it, many of my colleagues indicated in their recent projections, the majority, that they would see it as appropriate to make a move, to take a step in that direction this year if things continue on the current path and no significant new risks arise.
Thank you. Now I'd like to ask you about the stress tests also. Some people have argued recently that the Fed should put the economic scenarios it develops for the stress tests out for formal notice and comment for the public and for interested parties in order to let industry and others weigh in on the assumptions that you use. And of course, the fact that the Fed can tweak these scenarios every year to account for new market developments is one of the main reasons why I would say they're useful. So could you respond to that quickly?
Very briefly, please.
Just very briefly, we want to make sure that those scenarios are based on timely information and address the most significant risks we see. We have put out for comment both the principles underlying our stress tests and information about how we construct the scenarios so firms have quite a good idea of what they can expect in terms of a scenario that they'll face, but all the details we don't put out for comment. It would
the time of the gentlelady
delays.
Time of the gentlelady from New York has expired. The chair now recognizes the gentleman from New Jersey, Mr. Garrett, chairman of our Capital Markets Subcommittee.
I thank the chairman. Thanks, Chair Yellen. As you know, last week there was the big FOMC meeting, and surprise. To no surprise, the Fed decided to do what? To continue the extraordinary accommodative monetary policy. Now, I know you have taken the position that the Fed's position are all purely data-driven, and that's where some of the questions were before, and that has absolutely nothing to do with politics. But, you know, less and less people really do believe that. Let me just give you two or three headlines out of last week regarding the FOMC meeting. From Politico, from right around here. Yellen helps Clinton dodge a bullet. From the LA Times. Is the Fed politically biased? Well, look at its interest rate decisions as the election nears. From Market Watch, a Fed rate hike and other important decisions, again, being put off until after the election. See, Chair Yellen, you have told our committee and the public on countless occasions that the Fed is not subject to undue political pressure. But as the saying goes, perception is reality. And whether you like it or not, the public increasingly believes that the Fed independence is nothing more than a myth. And the Fed has an unacceptable, cozy relationship both with the Obama administration and with higher-ups in the Democratic Party. Now, I brought this up a year ago, and let me run through some of those points that I raised then. You personally have weekly lunches with political and partisan heads over at the Department of Treasury. There is, in fact, a revolving door between the Treasury appointees and the Board of Governors. Your predecessor, Chairman Bernanke, had made a decision literally just weeks before the President had to go before the voters in 2012. And looking at your record, your speech on income inequality, something you never talked about before, but which became a major political theme for the administration, and you gave it just weeks before that last election. Now let me give you one most recent one, and maybe you can just comment on this in a couple of yes and no's. There's little doubt about last week's FOMC meeting that potential implications for the markets and therefore the election. But it was reported earlier this year that Fed Governor Lael Brainerd contributed the maximum amount to the Hillary Clinton campaign. And she did so while she was a sitting member of the Fed board. And there was numerous reports that have come out, media reports, stating that the governor is angling for a top job with the Clinton administration if Hillary wins. So some basic questions, knowing that's all out there on the table. Because of the appearance of conflict and impropriety there, has Governor Brainerd ever offered to recuse herself from voting at the FOMC? Has she? Yeah.
Governor Brainerd, like all of us, is subject to the restrictions of the Hatch Act.
Right. So has she offered to recuse herself because
No.
of her political involvement? The answer is no. Have you ever asked the I'm sorry.
The Hatch Act does not prohibit political contributions.
I get that, and so, but we see the appearance of the conflict, and so it's a basic question. Has Governor Brainerd ever offered to recuse herself? And the answer is no. Have you ever asked Governor Brainerd to recuse herself because of her close involvement with the campaign in making contributions? Have you ever asked?
She's acting in a way that is permitted by the rules
So your answer
we're
is,
subject to.
Right.
And
So
each one of us has to
I
decide
understand that. So the
for
answer
ourselves.
The answer is she has never offered to recuse herself. The answer is you have never asked her to recuse herself. To your knowledge, has Governor Brainerd been in contact with the Clinton administration, or Clinton campaign, regarding a potential job in a potential future administration? Are you aware of that at all?
I have absolutely no awareness of that.
There have been published media reports talking about that, so you're not familiar with those media reports.
What's important to me is whether or not in our decision-making, our collective decision-making, I see politics being brought to bear in reasoning about our decisions, and I have never seen that on the part of any of my colleagues.
If you learn that she has had communications with Clinton as far as trying to get a job, would that change your opinion as to whether she should be asked to recuse herself?
I don't think that there is a conflict of interest there.
So a federal governor can be in direct negotiations with a political campaign looking for a future job, and that is not a conflict as far as you're concerned.
We do have.
No, is that a conflict or not? If they are having direct negotiations with either political party to ask for a job next year while they're a sitting governor, do you see that as a conflict?
Will the gentleman yield?
I would like to have an answer. Is that a conflict?
Will the
and if it is a conflict,
yield?
will you be asking the governors whether they are engaged in such activity?
Will the gentleman yield?
The gentleman apparently is not yielding. The time of the gentleman has expired. Can the witness give a brief answer?
I would have to consult my counsel. I'm not aware that that's a conflict, but I would.
The time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Velasquez.
Thank you, Mr. Chairman. Chair Yellen, Puerto Rico is currently facing a historic crisis. 46% of the population lives below the poverty line, 3 times that of the U.S. mainland. Employment in Puerto Rico stands at roughly 1 million, down nearly 300,000 from 2007. In the meantime, the U.S. economy has gained almost 10 million jobs in the same time frame. On top of these challenges, the island is struggling with Zika virus, and last week, a blackout swept the island. When the U.S. mainland faced severe challenges from 2007-2009, Congress passed and the President signed sweeping stimulus legislation, the American Recovery and Reinvestment Act. Do you believe that this legislation was helpful in fostering an economic recovery for the U.S.?
Well, I do think Puerto Rico faces very serious economic and fiscal problems, as you have described. They have been building for a long time, and the Commonwealth faces very significant challenges. I think the framework that Congress passed provides tools that maybe enable the Commonwealth to avert some worst-case scenarios. The ability to restructure debt should make it possible to put in place a fiscal adjustment that will be one that's less uncertain and hopefully entail smaller cuts to government spending.
I understand all that, Chair Yellen. It will take time for the Fiscal Control Board to do its work. And the situation in Puerto Rico is really very difficult at this time. My question to you is, how can we spur investment in Puerto Rico, how can we foster economic growth and not wait for the Fiscal Control Board? Because the reality is people are leaving the island. The most productive workforce is leaving the island. They're facing serious problems with a healthcare system that is broken. And my question to you is, do you believe that a Puerto Rico-focused stimulus plan will have similar effect on the island's economy like we did here in 2008, 2009?
So this is really something I'm not an expert on, what the appropriate programs are for Puerto Rico to deal with its longstanding problems, and I think that's squarely a matter for Congress and the administration to consider.
Okay. Thank you for that answer. We cannot forget that Puerto Rico is part of the United States, that we have a responsibility, a moral obligation. After all, we don't provide priority in some of the important issues that they're facing, such as Medicaid and Medicare. Chair Yellen, last Friday, the Federal Reserve Bank of Philadelphia launched a research and advocacy initiative to examine the interaction between economic inequality in the U.S. and its implication for macroeconomic prosperity and growth. What is the Fed hoping to learn from this initiative, and how is the Fed hoping its findings will further the economic inequality discussion?
So
I don't see it as a political plot. I see it as a contribution in terms of, promoting economic growth among those who have been left behind.
yes, I think the high level of poverty and inequality in the United States is a concern, should be a concern to all Americans, and an important challenge that our nation hopefully will address. And this initiative is really focused on trying to understand what some of the key factors are that are driving those outcomes, and looking at practice to see, based on real-world experiences with programs that are attempting to address poverty, what works and what lessons can be learned that might be of use to communities trying to deal with entrenched poverty.
Thank you.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Missouri, Mr. Luca Meyer, chairman of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman, and Chair Yellen, welcome. We've spoken a lot about the sheer volume of rules coming out of the Federal Reserve. It's rule after rule, layer of regulation after layer of regulation, and that's really impacting financial institutions across this country, whether they serve a small community in Missouri or customers across the globe. Now we have the merchant banking and physical commodities involvement by the Fed, as my colleague, Mr. Nagelbauer, has indicated. And I hope that you work with this body with regards to those rules. Fed officials have made statements to the effect that the benefits of merchant banking outweigh the potential risks, yet we seem to be intent on trying to find a solution for there is no problem. That concerns me greatly, and I can assure you we intend to have a number of questions, written questions for you to respond to with regards to that issue. Today, though, I want to discuss the SIFI designation stuff that Mr. Tarullo announced this past week. I think it's important. We suddenly now recognize that the SIFI should be designated based on risk, not just on size. That's an important thing. Secretary Liu was here last week, made that same comment, basically, that we need to look at other factors other than size, and that seems to be your position as well now. With regards to that, can you tell me what administrative costs will be incurred by the Fed to remove the CCAR requirement?
I'm sorry.
Can you tell me what the costs by the Fed would be to remove the CCAR requirement of being a SIFI, the stress test?
Well, we believe that stress tests are a very important way.
I'm not talking about whether you do or do not do them. What is the cost that you're going? What's the savings that you're going to have, or is there a cost to de-designate? Is there a cost to administratively remove the CCAR requirement? Is there a cost to do that?
Is there a cost in terms of dollars and cents that we spend on it?
Does the Fed have to Is it cost you something to administratively remove the CCAR designate?
Does it cost us to implement it and to run the tests? And would we? Are you asking me?
I'm asking you to remove the requirement. Does it cost you money?
Does it cost us money to remove the requirement? It does not.
Yeah, the CCAR requirement. Does it cost you money to do that?
Does it cost us money? No.
Okay, that's what.
But I think it would be a cost in terms of safety and soundness. I think this.
No, I'm not talking about. I'm talking about the Fed. Does it cost you money to remove the CCAR requirement? You said no. That's what I need. And that's the answer to my question.
Well, any cost also that we incur in carrying out CCAR in the stress testing is passed on to those institutions who pay for the cost of their supervision.
Okay. Last February, the Office of Financial Research conducted analysis of the systemic importance of 33 U.S. bank holding companies based on basically the tenets of my bill, H.R. 1309. And given that all this work has been done, can you tell me what you think the cost would be for FSOC to de-designate and redesignate a financial institution?
For FSOC to what?
For FSOC to de-designate or redesignate these institutions if they are no longer SIFIs, according to the bill. I have a bill that says you have to look at these things, and if it shows that the institutions are not SIFIs, you have to de-designate them, and they redesignate them if they are, just to analyze them. Is there a cost to that?
Well, yes, I think it's clear that these institutions.
Can you give me a figure?
No, I cannot give you a figure.
Okay. Can you give me a ballpark? Is it $100, $1,000, $1 million, $10 million?
I can't give you an estimate.
Well, the problem is that the FSOC staff, which includes the Federal Reserve, informed the CBO that the de-designation and potential redesignation of banks costs, there were over $50 billion in assets, would have an administrative cost of $60 million. Do you think that's reasonable?
I honestly don't know. I've not looked at it.
You have any idea how your staff arrived at that figure?
This is the FSOC staff.
Well, no, they did it in conjunction with the Federal Reserve staff, which is part of FSOC. Your staff came up with this figure. Do you have any idea?
I have not reviewed how they came up with that figure.
Okay. So if we write you a letter, you will be willing to give us a response on that as well?
Can try to do that.
Okay. Very quickly, you made a comment a minute ago with regards to what you've all done for community banks to help them with the regulatory problems, this inundation of rules and regulations. Can you give me several examples of that, please?
Examples of what we have done?
Yeah.
We changed the small bank holding company policy statement to raise the threshold for capital regulation of
I think
small.
we did that in Congress, if I'm not mistaken, no.
You did, and we raised, but we put that into effect. We have
Well, I'm glad to know that you implemented our law. Thank you very much.
The time of the gentleman has expired. The chair now recognizes the gentleman from California, Mr. Sherman.
Madam Chair, good move or non-move earlier this month at the FMOC. Now, some in politics on Monday will say that our economy is in such terrible shape that those who make economic policies are obviously incompetent. Then they'll come back on Wednesday and say it's urgent that we raise interest rates because our economy may overheat and economic growth could get out of hand. Only in this room can you juxtapose those two positions. We need to allow small business loans. I've been told by many bankers if there's a 2% or 3% risk that a business will go under, they can't make the loan. Jamie Dimon was sitting where you are now and said, well, he couldn't find qualified small business borrowers under that standard, so he sent his money to London where it was eaten by a whale. It would do a lot for the security of our financial system, and also help the economy of this country, if banks were able to make prime plus 3, prime plus 4 loans to businesses that had a little risk, and of course provide a reasonable reserve. Instead, I'm told if you don't qualify for prime plus 2, you leave the office. I join the chair in saying that it's a good idea to tailor your regulations. And I would say that the more SIFIs you designate, the less significantly you will regulate SIFIs. And it's the hugest institutions that are really systemic risks. But, Madam Chair, I want to address the elephant in the room, or maybe I should say the stagecoach. I'll remind you that the FSOC has the authority to break up the biggest banks. And for that, I've said that before in this room, people said you must have animus to the true global SIFIs. No, study microbiology. The protozoa reaches a certain size, and then it divides. That's healthy. That's normal. If a protozoa can divide in a healthy manner, you'd think the smartest minds on Wall Street could as well. Too big to fail is too big to exist. Let's look at the elements of that. Too big to fail is too big not to bail. That's why we bailed them out in 2008. Too big to fail is too big to jail. That's why Eric Holder said he can't indict certain executives and institutions, because if he did, it would have too big an effect on the economy. Too big to fail is too big to compete with. That's why some studies say they get 80 basis points off their cost of capital. It might be less, because of the expectation of those providing the capital that if they get in trouble, we'll bail them out. But Wells Fargo has identified two additional reasons to break these institutions up. Because they created a system where they hired good Americans and turned 5,300 of them into felons. 2 million felonies. They failed to monitor the system. When they saw that there was that some individuals had created phony accounts, they fired 1,000 of them and didn't change the system and didn't fire the executives that created the system that created the first 1,000 felons until they had 5,300 felons. Now, from a Democratic side, I say too big to fail is too big to manage. From a Republican side, I've heard too big to fail is too big to regulate. But whether the fault is the regulators who can't regulate it or the managers who can't manage it, too big to fail is too big to exist. So my question for you is, will you seriously consider using your authority, as I think you're required to review and consider using your authority, will you at least seriously consider breaking up Wells Fargo?
Well, we will hold the largest organizations to exceptionally high standards of risk management, internal controls, consumer protection. We expect their
but
boards.
If you broke Wells Fargo up, then instead of trying to hold them up to those really high standards, people could choose, which financial institution to go with. They wouldn't pose a systemic risk. By saying you're going to hold the giant institutions up to standards, something you have not been able to do 2 million times, 2 million phony accounts. So you're saying you're going to continue to do a great job of regulating the too big to fail because you're not going to break them up?
Well, we believe it is possible, even though it's extremely challenging for organizations to comply with the law.
2 million phony accounts not detected by the regulators. Break them up.
Time of the gentleman has expired. The chair now recognizes the gentleman from Michigan, Mr. Huizinga, chairman of the Monetary Policy and Trade Subcommittee.
Thank you, Mr. Chairman. And Madam Chair, appreciate you being here, but quite honestly, no offense, wish you weren't. We need to have the Vice Chair of Supervision to be here. This is something that the administration has refused to, a position that the administration has refused to appoint for 6 years now. Governor Trujillo has essentially fulfilled the function as position of from his position as chair of the Fed's Board's Committee on Supervision, but he is not in this position. And quite honestly, by refusing to fill this position, I believe that that the President has deprived Congress and the American people an opportunity to hold the Fed accountable through these semi-annual hearings. And this is a requirement of Dodd-Frank, the much vaunted Dodd-Frank that some of my friends believe is somehow holy script that can't be changed or altered in any way, but they conveniently refuse some of those other areas. Do you believe that there should be a nomination to fill this position?
We would certainly welcome a nomination.
Have you brought that up with Secretary Lew in your weekly lunches?
This is a matter for the administration to
But that's not my question.
decide.
Have you brought it up? I mean, you're having to be here in somebody else's stead. Have you brought it up with the administration or specifically Secretary Lew or anybody else?
I'm not going to discuss what I have discussed or haven't with the Secretary. As I say, it's an administration responsibility, and we would certainly welcome a nomination.
I guess we'll continue to hold you responsible for that obligation, which is something that you shouldn't be held for. But that's your decision.
I think.
I'm going to go on, but do you believe that any and all rulemaking regarding regulatory or supervisory or supervision should be suspended until this vice chair is actually named?
No, because I think the Board of Governors is charged with supervision and putting in place regulations, and we're carrying.
And then who do we hold responsible
that
for
out?
that? Who do we hold responsible for that then?
Well, I'm responsible, and my colleagues are responsible, and I'm.
As long as you're willing to fulfill that obligation, that's an additional burden on you. But
Congress assigned the Board of Governors that responsibility, and I am certainly sharing that responsibility with my colleagues.
I need to, this is going fast, so I need to move on. I want to talk a little bit about monetary policy versus regulatory and supervision and supervisory roles. The fact is that in my Fed Oversight Reform and Modernization Act, the FORM Act, and by extension the Choice Act, we are trying to bring some separation to your function as monetary policymakers as well as your regulatory and supervisory roles. Former Senator and Banking Committee Chairman Chris Dodd, as well as Chairman Frank at the time, had advanced legislation or advanced the notion that those ought to be separate duties, and that your regulatory and supervisory roles ought to be put on budget. I'm curious, were they wrong in that assessment?
Well, Congress decided to.
So you would welcome then, if Congress decided, you would welcome having that separation and putting your regulatory and supervisory roles under budget and with review, just like everybody else, every other regulator, versus the separation of your monetary policy duties.
Well, the banking agencies do not have their budgets mandated by Congress. They're covered by collections from the industry. I would very much worry that we would lack the flexibility under congressional appropriations to ramp up our supervision at times when
But we've got an alphabet soup of all these other regulators that are there as well, and so it seems to me you're wanting to have your cake and eat it too. You want to have this super duper regulatory role where it's fed uber alles on this stuff, but you're not willing to subject yourselves to what the other regulators go through, and that just seems that. Rarely do I say that I agree with Barney Frank, but I believe that Chairman Frank at the time had this right, and that there is that separate role. My last issue, as we're quickly closing out here, some have believed that Dodd-Frank cannot be changed, at all, any way, shape, or form. You said on page 14, page 4, a number of times that there ought to be these adjustments. Have you spoken to these senators or other reps who disagree with you and say that we cannot touch Dodd-Frank?
A very brief answer, please.
Well, we have said that those would be desirable changes.
I hope you're expressing that to the members.
Time of the gentleman has expired. The chair now recognizes the gentleman from New York, Mr. Meeks.
Thank you, Mr. Chairman. And it's a pleasure to welcome you back to this committee. And let me just say on the outset, I also, thank you for staying with who you are, being nonpartisan and independent, despite there being some, especially in the presidential politics of which we are currently engaged in, who's trying to say that your decisions are based upon a partisan way. In fact, I think that it's good when you are criticized from both the left and the right, and from everyone. That probably means that you're doing the right job because you're not focused on either side. And we in this committee specifically reinforced the banking supervision's powers of the Federal Reserve in Dodd-Frank because there was clearly a need to heighten our banking examinations and regulatory framework. I think that that's clear from what took place back in 2008. The good news is that we are seeing banks taking bolder steps to reduce risks, as you've indicated, and to exit out of certain risky activities. We do see some of that happening. Even if some would say that banks are bigger today than they were before the financial crisis, that probably may be true from a simplistic perspective, but it is not a complete and accurate picture because not only have banks exited some of their riskier businesses, they've also boosted their capital and liquidity buffers, which surely increases the size of their balance sheets, but it makes them safer and sounder institutions. I mean, so this is a complicated stuff, which is true. And then yet we still have Wells Fargo, which, causes us to have great concerns as to what and where we need to go next. And we'll have questions with him. So there's been some progress, but then there's also unintended consequences. And I want to shift to that now just because it is well documented that one of those unintended consequences of banks de-risking has been that banks are getting out of certain communities and countries, and they are also denying services to millions of lower-income Americans, not because the risk is too high, but simply because the profit margins are not considered high enough. There have been serious consequences on vital correspondent banking relationships that are critical to international financial flows also. But another major problem happening in several communities here, including in a district like mine, is that banks are closing branches. In fact, economists from the Federal Reserve Bank of New York released a report last March entitled Banking Deserts, Branch Closings, and Soft Information, showing that U.S. banks have shut nearly 5,000 branches since the financial crisis. As a result, residents of low-income neighborhoods have become somewhat more likely to live in a banking desert. That is why I have called to revamp of the Community Reinvestment Act in a letter that was just mailed to a number of banking regulators and co-signed by 40 of my colleagues. Some are still signing on. So, Chair Yellen, it is obvious that CRA is not working as it was meant to work when it was passed 40 years ago. And I've had this discussion with OCC Comptroller Curry, and I strongly believe that part of the solution resides in enabling greater collaboration between large banks and CDFIs, including minority deposit institutions, so that these institutions can take over assets and branches before they close, and more importantly, so they can preserve banking services and relationships in low-income communities of color. So the Comptroller and I are in constant dialogue on this, and I would love to get some of your thoughts on this matter.
Well, I am concerned about banking services in low-income communities, and we are working with minority depository institutions to provide support to them in enhancing the very important and valuable role that they play in ensuring the provision of services to these communities.
So do you believe that we should, 40 years ago there was one thought of view, banking and CRA was put in so that we could make sure that you had institutions. Can you believe that there's ways that we can revitalize or revamp CRA to deal with the institutions and what's taking place today so that these communities are not neglected and then become part of banking deserts?
Well, we are having a look at CRA, and the agencies have put out additional guidance in recent years that's meant to address issues that have arisen, and we will continue to look at what further guidance might be appropriate.
Time of the gentleman has expired. The chair now recognizes the gentleman from Wisconsin, Mr. Duffy, chairman of our Oversight and Investigation Subcommittee.
Madam Chair, welcome. Obviously, looking back to 2008, the crisis had a huge impact, not just on the financial service sector, but had a huge impact across our country and on many of the families that we represent. And I would argue that this massive Dodd-Frank bill was passed in a time of fear, where people were concerned about the future of our country and the future of their family. And a 2,300-page bill was passed before the dust had even settled, and we had a full analysis on what caused the crisis. And we were told by our friends across the aisle, who I would argue opened up their cabinets, their file cabinets, and dumped in every wish bag issue that they had for probably a decade. But they made a promise to the American people that when they passed that bill, they would be ending too big to fail. Because people were concerned not just about the economy, but the fact that the taxpayer, their money was going to bail out large financial institutions. Do you agree now, almost a decade on, that we have ended too big to fail?
Well, I think we've taken very significant steps toward...
No, Madam Chair, that's not my question. We were promised that we would end too big to fail. I wasn't here. That they would end too big to fail. So I think the American people have a right to know what you think. Have we ended too big to fail? Yes or no?
So, as I said, I think too big to fail is a less significant problem now than it was before.
So you're saying it's still a problem? We haven't eradicated the threat, have we? Too big to fail still exists. Yes?
I think we've made very important and meaningful strides toward ending it.
Madam Chair, these are simple questions.
I'm sorry, I don't think it's a black or white thing.
So you can
yes
say yes
or no.
I can tell you, Congressman Duffy, we have ended too big to fail. America is better off for Dodd-Frank and the fact that I'm the chair of the Fed. Or, frankly, no, we haven't. We haven't ended too big to fail. We've made progress, but we haven't ended it.
We have done a great deal to make it possible for a systemic institution to be resolved successfully.
So I'm going to take that.
The odds of accomplishing that are much better.
I think what you're, if I'm going to clear the smoke, you're saying we made progress, but we haven't ended too big to fail. And I think you're in a safe zone because Elizabeth Warren even admits we haven't ended too big to fail. The ranking member and my friends across the aisle will admit clearly in hearings here, we haven't ended too big to fail. So my question for you is a 2,300-page bill giving you and other prudential regulators significant authority that has had a huge impact on the financial sector and on our economy. If we haven't ended too big to fail, is it a failure of Dodd-Frank or is it a failure of the Fed?
I'm sorry, I'm not willing to describe it as a failure because, number one...
Well, we haven't ended too big to fail.
I'm sorry, no, we have made great progress in trying to achieve that, and it is not a black or white issue.
Does that answer work for my constituents? When I go home and said, this was a devastating crisis, it had a huge impact on your family, we're 10 years on, we had a 2,300-page bill, you can't get a loan from your credit union or your community bank, I'm not done, or from your community bank, and Chair Yellen came in and she said, we've made progress.
So we have a system that is much safer and sounder. It is much more resilient. It has much more capital, much more liquidity, and better, although certainly not perfect.
I full-heartedly disagree with on many issues with Elizabeth Warren, but at least she's truthful on that one. Larry Summers recently, I'm sure you read his piece, said that to our surprise, capital information is at least superficially inconsistent with the view that banks are far safer today than they were before the crisis, and some support for the notion that risks have actually increased. Larry Summers, do you disagree with Mr. Summers as well?
I do. I disagree significantly with that conclusion because it is based on the notion that markets properly evaluated the risks in banking organizations before the crisis, and nothing could be further from the truth.
I'm going to give you one quote. In 1788, James Madison worried that laws may become so voluminous that they cannot be read, or so incoherent that they cannot be understood. 2,300 pages in Dodd-Frank, 30,000 new regulatory restrictions, a 900-page Volcker rule, 600 pages of Basel III, and you can't tell me with all that rule and regulation that you haven't eradicated the threat of too big to fail.
Time of the gentleman has expired. The chair now recognizes the gentleman from Massachusetts, Mr. Capuano.
Thank you, Mr. Chair. Thank you, Madam Chair, for being here again. I just want to clarify a few things I think some of my colleagues made. I'm not aware of anybody who doesn't want to amend Dodd-Frank, including me. I want to amend it. I just don't want to gut it. Good amendments, thoughtful amendments, all for them. Gutting it, totally against. And that's pretty much the only bills we've been offered, is offered bills that would gut them.
Will the gentleman yield?
They're not going to get, not right now, no. But thank you. Too
Hold
big
my
to fail?
request.
Too big to fail? I agree. We should do more on it. That's why I offered the bill to bring back Glass-Steagall. All my colleagues are welcome to join that bill. That's why I offered H.R. 888 that the community bankers support. All my colleagues are welcome to join that bill. And that's why I joined my colleague on the other side, Mr. Garrett. Now, my God, if you're not paying attention when Garrett and I can agree on H.R. 2625 that directly relates to the Fed's ability to bail out banks. All my colleagues are welcome to join that bill as well. I know Ms. Yellen wouldn't like that bill, and I appreciate that, but it doesn't kill you. It just kind of squeezes a little harder. There are bills that are out there to do more. All you got to do is read them and join us. If Garrett and I can do it, you sure as hell can find a way to do it. Don't get used to me and Garrett working together either, but that's a different issue. Ms. Yellen, let's assume, for the sake of discussion, that we had a large bank, a big SIFI, one you're keeping a very close eye on, that over the last 5 years has had 16 enforcement actions against them, including one from the Fed. Let's assume the bank had a Fed fine of $85 million. And in that agreement, the consent agreement that they signed with you, they said, or you said, internal controls are not adequate to detect and prevent instances when certain of its sales personnel, in order to meet sales performance standards and receive incentive compensation, altered or falsified income documents and inflated prospective borrowers' incomes to qualify those borrowers for loans that they would not otherwise have been qualified to receive. That was 2011. They're just obviously hypothetical, of course. And since that time, we've had 15 other violations across the board with pretty much every alphabet agency you can find: DOJ, CFPB, OCC, FinCEN, FHA, SEC, NCUA, and pretty much every state in the nation, totaling almost $11 billion in fines. Those actions included defrauding student loans, mortgage holders, credit unions, identity protection, kickbacks, insider trading, defrauding Freddie, defrauding Fannie, worker health issues, discriminating against African Americans and Hispanics, defrauding investors, foreclosure abuses, and on and on and on. And then just this year, earlier, when you rejected their living will, your letter cited concerns about quality control, senior management oversight, accuracy, the consistency of financial and other information reported, even though the firm's leadership steering committee had input to the plan. And now we have a same bank, just defrauded $2.5 million of its own customers. Its own customers. I'm sorry, $1.5 million. Don't you think it's time the Fed does something? How long does this stuff go on before you get outraged and take action?
Well, as you pointed out, we have done something. The action that you described in 2011.
You know that an $85 million fine to this bank is laughable. You know that. I know you know that. It's a lot of money to me and everybody I know. But to this bank, they made $23 billion last year. God bless them. They're a very successful bank. An $85 million bank is barely a footnote in their annual report, and you know that.
Well, as you pointed out, many regulators have been involved in...
Oh, I'm going to have my fun with them, too. It's just your turn today.
So we're, in the case of this institution, we're the supervisor of the holding company. We have already instituted a review of all of the largest banking organizations because we are very concerned with all of the compliance problems and violations of laws.
You know they're
that
laughing
have
at you,
occurred.
right? You know they're laughing at you.
The time
Well,
of the gentleman from Massachusetts has expired. The chair now recognizes the gentleman from New Hampshire, Mr. Ginto.
Thank you, Mr. Chairman. Chair Yellen, to your right.
Sorry.
Thank you. Thank you for being here today. I want to talk a little bit about community banks. You and I know the importance and the role that they play in our financial ecosystem. My state of New Hampshire is a small state, yet a resilient state, 1.3 million people, and we have very close relationships with our community banks. We've got 10 federally chartered banks, we have 16 state chartered banks, and we have 10 out-of-state chartered banks. So it's not a significant number, but they are very important and critical to consumers. But due to the severe regulations that community banks in my state are subject to, they are now limiting products and loans and services to their customers and my constituents. When community banks should be focused on providing access to credit for consumers, their focus and attention on meeting compliance with the burdensome regulatory requirements seems to take the priority of their time. I get reports from my community bankers on a regular basis that they can spend up to 25% of their time and resources on compliance, and this has been increasing as a result of the growth in the regulatory requirements that continue to be placed on them. So my first question would be, do you believe that there is a disproportionate impact of regulatory compliance on community financial institutions, institutions that are smaller, that service customers in New Hampshire?
So we want to do everything we can to reduce burdens on community banks and recognize that they are laboring under a significant set of regulatory burdens. We're going through the AGRIPA process and looking at a number of concrete ways in which we can reduce that burden, and we've taken a number of steps on our own to reduce the frequency and intrusiveness of exams, to make it more risk-focused, to do more work not on the premises of the bank to try to reduce burden. You asked if the burdens had fallen disproportionately on community banks. The fact that they're smaller means that these burdens can be significant relative to their budgets, but the most restrictive requirements have been focused on the larger institutions, particularly the USG SIBs, that are subject to a much more stringent set of...
But you do think there is a disproportionate impact on smaller banks, community banks?
There's quite a bit of research that's taking place. In fact, we have a conference that's taking place at the moment that's looking at those burdens, but
well, the reason
they are significant burdens for a very small bank. There is a certain fixed cost involved in doing it.
The reason I'm asking is we've had 2 mergers in the last 6 months in the state of New Hampshire, and my fear is that that's going to continue. So I hope that you could identify very specifically and very quickly before the end of the year areas where we can reduce that regulatory burden. New Hampshire bankers are going to be coming to Washington tomorrow to meet on this very subject. They're very interested in it, and because our economy requires and relies on them. A different point I want to bring up, in your written testimony, you recommended that Congress consider carving out community banks from the Volcker Rule and the Dodd-Frank Act's incentive-based compensation rules. Regarding your recommendation that community banks be carved out of the Volcker Rule, would you agree in concept that an approach worthy of consideration would be to exempt the Volcker Rule those banking institutions that do not engage in a material way in the activities that the Volcker Rule seeks to regulate, but keep those entities that engage in trading activities subject to the Volcker Rule?
So we've certainly said that we thought smaller institutions should be exempt. And the exact definition I would have to look at. More carefully.
Okay, you also talked earlier about the 80,000 jobs per month that this economy is generating. Can you tell me, and you said the labor participation rate is changing, can you tell me what percentage of the labor participation rate is right now? Is it below 62%?
No, I don't believe so. Let me just have a look. It's currently 62.8%.
Okay, so I'm sorry,
Time.
my time has expired, but I don't think that has changed over the last several months.
Time of the gentleman has expired.
It hasn't changed over the last several
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Hinojosa.
Thank you, Chairman Henserling and Ranking Member Waters, for convening this hearing. Welcome, Chair Yellen, and please accept my sincere gratitude for your leadership at the Fed. I commend you for acting in the absence of a Vice Chair of Supervision for regulation of bank holding companies and non-bank financial institutions. Confidence in the safety and stability of our financial system continues to strengthen even in the face of global market unpredictability and other emerging threats. We can attribute continued growth and stronger and more resilient economy to your leadership and the protections afforded by Dodd-Frank Act. My first question, Chair Yellen, is, in your opinion, do our financial regulators currently have the discretion they need to correctly tailor regulatory and supervisory standards, or should we in Congress take action?
Well, I think by and large we do have the scope we need to tailor these regulations. We've pointed out a few areas where we have limitations. The Volcker rule is one, and the incentive compensation rules are another, where we can do some tailoring, but not as much as we would like. Congress did act to address the restrictions we faced in the area of insurance in designing an appropriate set of capital standards for insurance-centered savings and loan holding companies, and we appreciate that and have used it to propose a set of capital standards for those companies that we think is appropriate. So there are some areas where we've needed Congress's help, but by and large we have a good deal of scope to tailor as we see appropriate.
You need to know that I continue to hear from banks of all sizes in my congressional district that they are burdened by regulations and costly stress tests. Several changes to the yearly stress test known as the Comprehensive Capital Analysis and Review were announced on Monday. Can you tell us what changes are being made to this review process and how that is expected to help community banks that are not internationally active nor participating in risky non-bank activities? And also, there are regulatory relief there was in the Wall Street Journal an article that talked about trying to have some regional bank systems given some, if they are from $200 billion in assets or less, being given some relief.
Yes.
Talk about that for me.
So at the moment, banks over $50 billion have been part of our so-called CCAR, comprehensive capital and stress testing regimes. And the proposal that we put out on Monday that Governor Trujillo described would exempt from the qualitative parts of that process bank holding companies under $250 billion that do not have significant foreign activities or significant non-banking activities. So the less complex of those banking organizations They would need to conduct the quantitative stress test, and we would conduct that, but the remainder of the capital evaluation, the qualitative part, they would no longer be subject to.
I'm also wanting to address the problems that in Wall Street and some of the investors, especially working families investing in their 401ks. How are China's economic troubles affecting the United States economy? And as the largest foreign holder of U.S. Treasuries with over $1 trillion in reserve, is the Federal Reserve concerned that recent selling of large quantities of Treasuries by China could significantly and negatively affect the U.S. dollar?
Well, China's economy has been slowing from decades of very rapid growth. That's something to be expected, given all the progress they've made and the desirability of transforming their economy to a more consumer-based economy. By and large, that process is proceeding, and it's a good one from the standpoint of the United States, but it's very challenging. And earlier in the year and last year, there were disruptions in markets related to their currency, their approach to managing their exchange rate. They sold treasuries mainly to support their currency, which was under downward pressure. And in recent months, I think markets have been much calmer. I think they've
the time of the gentleman from Texas. The time of the gentleman from Texas has expired. The chair now recognizes the gentleman from Oklahoma, Mr. Lucas.
Thank you, Mr. Chairman, and thank you, Chair Yellen, for being here. I share, along with my colleagues, Mr. Nagelbauer and Mr. Luetkemeyer, concern over a proposed rule that the Fed released on Friday, increasing the cost for financial companies to engage with their clients in physical commodity markets. As a member of this committee and a former chairman of the House Agriculture Committee, I have worked with a number of end users on issues associated with reform and regulation within the derivatives markets. And you and I have discussed on various occasions the nature of my district, 3rd District of Oklahoma, and the importance of stable commodity markets to my district. Over the past few years, I've heard from a number of commodity end users about their concerns on this issue. And I, too, am concerned about the impact this will have on our businesses and municipalities and their ability to participate in commodity markets. While we should, of course, continue to address risks to safety and soundness within our financial system, it appears that this rule simply seeks to discourage a company's participation in these activities through capital requirements rather than through an actual effort to target and mitigate risk within the system. In crafting this proposal, I guess my questions would be the following. In crafting this proposal, did the Fed examine historic loss data for banks engaged in physical commodity activities, as well as how losses in this business related to losses in other parts of the bank's business?
We did take a very careful look at the nature of banks' involvement in these areas and considered the risks that that activity entails. And it is important to recognize that financial holding companies would still, under these proposals, be permitted to engage in physical commodities trading with end users. That's not something that would change. What this proposal does is put in place additional risk-based capital requirements for activities that involve commodities for which federal or state law would impose liabilities if the commodity were released into the environment. So we're worried about environmental risk.
But, Chairman, if you could provide us with the information on how you made those determinations, what the historic perspective was, how it's actually affected businesses, I think I and the rest of the committee would appreciate what the historic foundation was. It also appears that you're raising risk weighing to 300% for companies that engage in this business, which will, of course, make it much more expensive for all of these companies. Could you also provide the committee with the analysis that was used to arrive at this 300% as an appropriate amount? How did you get there?
We will get back to you on some details.
And I would simply note, Chair, again, I commented earlier, you and I have discussed this on many occasions. My district is agriculture and energy. We're wheat and cattle, we're pork, we're cotton, we're oil and gas, we're electricity, more and more every day generated by wind power. Having the tools to be able to hedge our products, having more participants in the markets give us, we believe, a much better price situation. If we restrict our tools to protect ourselves, if we restrict access to the markets by others, there's a great concern we will suffer, and of course, ultimately, the consumer who benefits from that supply will suffer too. One last thought or maybe a comment, and I'd like to reinforce one more time with you, Chair, of my interest and concerns regarding how Basel III treats derivative customers and their margin. Now, I understand that the Basel Committee negotiations continue, but recent reports are not encouraging for the end users in my district and the clearing infrastructure that has long supported their hedging needs. In this complicated world we live in, I guess what I'm saying is we need more tools, not fewer. We need more cost-effective tools, not more expensive tools. As in the case with Basel III, help protect us from those kind of consequences if it gets out of hand. And with that, Mr. Chairman, I guess I yield back.
Gentleman yields back. The chair now recognizes the gentleman from Massachusetts, Mr. Lynch.
Thank you, Mr. Chairman. And Madam Chair, thank you for being here. I really appreciate it. I want to go back to Mr. Capuano's questions around the Wells Fargo scandal. Now, I do understand that there's been a small fine paid by Wells Fargo, but in light of what they did here, 2 million fraudulent accounts, I know they fired 5,000 lower-level employees. There's been a little bit of clawback by the bank itself. But in terms of your role, you are the primary regulator for the bank, for Wells Fargo Holding Company, right?
We're the primary regulator for the holding company, but these abuses occurred in the bank.
I understand.
And the controller of the currency and the CFPB have authority, and they're the ones who brought these actions. We weren't involved.
And I give them great credit for that, as well as I think the Los Angeles authority was involved as well. Is there anything that you can do, looking what happened here? This was widespread. This is a disgrace, really, what happened. 2 million fraudulent accounts, and the low-level employees who were fired, didn't just think this up themselves. They obviously had incentives that were put in place. And any ideas from your standpoint as what might be done as a regulation or as legislation to prevent this from happening again?
Well, the controller of the currency and the CFPB have demanded in their actions that remedies be put in place. We now have initiated a broad-based review for all the largest banking organizations of their compliance regimes and governance.
Let me just ask you, this is a huge, huge thing here. Again, 2 million fraudulent accounts. Can you think of any circumstances where a bank might be required to admit guilt? There was no admission of guilt here at all by the CEO or the bank itself. There was no admission of guilt. I mean, if it didn't happen here, how can we even imagine ever that a bank to take responsibility for what they're doing? And I think by doing this, by continually letting the banks off the hook and nobody has to admit guilt, you actually build a perverse incentive for this stuff to happen. And I just it blows my mind that they're getting away with this and they're paying a little slap on the wrist fine that's not bothersome. And the CEO the other day said, well, it was only 5,000 employees. We got 100,000 employees and 5,000 did this, and sort of just blowing it off. It just
I think it is very important that senior management be held accountable, and that when there are individuals, identifiable individuals who have been involved in wrongdoing, that
I know they're all lawyered up, but But I think there's value in just getting after them. Just getting after them. I don't care if you get a conviction or not. Just get after them and make their life hell. And we've got to create a disincentive in this system at some point for these CEOs to do the wrong thing. They completely, they completely ignored any of the safety and soundness and just basic responsibilities here. And I'd like to see somebody held accountable for that at some point. Let me ask you, it's a very clubby environment, the banks. And I would be amazed if this practice were just limited to Wells Fargo. I think it's probably the practice at a lot of banks. There's a lot of cross-pollination going on. People work for one bank, go to another bank. Are we looking at any of the other big banks doing this type of thing?
Well, as I see, yes, we are. The CFPB is in all the largest banks, and we are undertaking a look comprehensively, not only in the consumer area, but compliance generally, because there have been a very disturbing pattern of violations. They occurred in the mortgage area, in foreign exchange trading, in many different areas, sanctions violations, LIBOR, and we're taking a comprehensive look at the biggest banks.
All right, thank you. I have 17 seconds. I just want to say in closing what a wonderful job the OCC and especially CFPB did on this. This is why they are there, and I very seldom hear great things about the CFPB. They did an amazing job here. This is a huge, huge win for the CFPB, and it redoubles my faith in that agency. Thank you. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from California, Mr. Royce, chairman of the House Foreign Affairs Committee.
Thank you, Mr. Chairman. Thank you, Chair Yellen. Good to see you today. I had a question, maybe it's a bit to follow up on Mr. Ginta's point about the unprecedented consolidation that we've seen in community financial institutions, where there are fewer and fewer of them, and these smaller institutions have fewer assets over which to spread their ever-growing compliance costs. So they often seek those economies then through mergers, and that's what leads to this conundrum now of a situation where we've got fewer banks today than we did during the Great Depression. And are you worried about the consequences of consolidation for communities and for our economies, and eventually for over-leverage as you end up with just a few big institutions having so much?
Well, I do think it's essential that we have a vibrant set of community banks serving America's communities. They play a very special role in our financial system, and it's important that they remain healthy. Reducing regulatory burden is important. It is something that we will seek to foster using every available tool that we have. Community banks face an challenging environment, though, for reasons that go beyond regulation. The low level of interest rates and flat yield curve and slow pace of growth in the economy are also factors that are making it difficult for them to thrive. But they are tremendously important at the role they play for American households and businesses, and we will certainly do everything that we can to relieve burdens on them.
Yes, and some of that's driven by monetary policy, some of that's driven by fiscal policy. So that's another way in which they're adversely impacted by decisions made in Washington. So it seems to me at the heart of the consolidation, as you say, are these, well, it's really an avalanche of rules that have forced small institutions to hire extra staff. That's the situation. The economy is a scale for them. And with that in mind, you said earlier that you're looking for concrete ways to reduce regulatory burdens on community banks, and you gave us some very specific recommendations on merchant banking and commodities activities in the Section 620 report that you released. Can you promise to send up specific legislative ideas as it relates to regulatory relief for community banks? If we could ask that of you. And then for now, I've got some questions on the report we received, because as part of the Section 620 report, did you study the effect that a repeal of merchant banking authorities and the loss of $27 billion in capital would have on small and mid-cap companies? And are you confident that if we act on those recommendations that are in that report, there will be alternative sources of capital for portfolio companies? That's one question I wanted to ask. And another is, based on your answer to my colleague earlier, is it correct to conclude that the recommendations for legislation in the report are based not on historical risks, they're based on, I guess, a projection of the possibility of potential future risks? And the reason I ask those questions is because as we look back at the financial crisis, there's no evidence that merchant banking and commodity activities were part of the crisis. What was at the heart of the crisis was a concentration of risk in bad home loans and securities tied to those loans. So as you limit activities of these community banks, are you concerned that you are limiting the diversification of risk and thus adding to the concentration? The harder we make it on these banks, the more concentrated the risk in the big investment banks or the larger institutions. And that could have a very negative impact on safety and soundness. And that was what I was going to ask you.
So our evaluation was with respect to alternative sources of equity financing, that private equity venture capital would be alternative sources, and that the merchant banking contribution here is not very large, that it would not have a significant negative effect. Of course, banks would still be able to provide a wide range of lending, advisory, and other financial services to customers. That would include startup firms, technology firms, and others. And they would have the ability to continue making investments in financial firms.
The time of the gentleman from California has expired. The chair now recognizes the gentleman from Georgia, Mr. Scott.
Thank you, Ms. Yellen. It's wonderful having you back again. You know, each time you come, we talk about an issue that's dear to my heart, and that's the overwhelming unemployment rate facing young African-American men. Last time we talked, you said your monetary policy was a blunt instrument, and you urged Congress to introduce legislation to target this. Well, I took your direction, and I and my co-sponsors have introduced 2 pieces of legislation that I certainly hope you will say a kind word for. Because if you, knowing your dual duty as both inflation as well as unemployment, if you say a word of support here, you can help us pass these 2 pieces of legislation. Now, the first one is to deal with our crumbling infrastructure. That is coming. That is a big, big, big issue. What we want to do on this first bill is to address and develop a jobs and on-the-job training apprenticeship program targeting African-American young men ages 18 to 39. 18 to 39, they are the hardest hit for unemployment, nationally at 38%, and in some of our inner cities at over 50%, as you well know. It's in the news every day of the condition that many of our African-American communities are facing. And so we want to set that up. It will come under the Secretary of Labor, who will coordinate these programs. It will work with the labor unions like the IBEW, the plumbers and pipe fitters, the iron workers, steel workers, all of those unions who will be helping to build our crumbling infrastructure. And we will bring these training programs and job programs. And let me just say, they will be in high technology areas, because you can't do all this without computer coding, computer systems, the technical aspects. that are so desperately need. Very important for us to get those in there and get that program started. The second one has to do with the education component. As you know, every year, every 5 years, we have to reinvest in our what we call land-grant universities. Those 1890s and 1860s that were set up after the Civil War. Schools like Tuskegee University in Alabama, Prairie View in Texas, Florida A&M, all of those. Well, we want to create a new area. Now they can only spend the money in education, research, and extension. We want scholarships to get these young kids in there. The big jobs are opening in agriculture business. It's the food we eat, the clothes we wear, now energy, high finance with derivatives and all of that. So we want to do that, give each of these schools $1 million, which they can spread over that 5-year period for scholarships. Now, these bills are bipartisan. We have some excellent co-sponsors. Folks like Kevin Kramer of North Dakota, Marcia Fudge of Ohio, Brad Ashford of Nebraska, Mia Love of Utah, Alma Adams of North Carolina, Gwen Graham of Florida, now Pete Sessions, who is our House Rules Committee chairman, all are on this bill. So a fine word from you would be very, very helpful. And I'm going to ask my assistant if he may give you, would you take those to them right now, Tanner, so you could have those. All I'm asking, and I'm not asking you to use the blunt instrument, I'm asking to use your golden voice. And if you speak and say a kind word, it will help us get these bills passed. And not only will the African American community thank you, but all of America, white people, everybody. We all know that these young black men with this highest unemployment rate of 18 to 39 are also the child-producing ages. This goes directly at helping us deal with that family breakdown structure. So we thank you for that. Now, Madam Secretary, I want to ask you one other thing. You know, you have an opportunity to do something very significant because I understand that your Fed regional bank president in my hometown of Atlanta, Dennis Lockhart, is retiring. We've never had an African-American regional Fed president. I'm asking you, take this opportunity to make history. We have many excellently qualified African Americans who could do this. And finally, I want to applaud you and Frank Torillo for what you're doing with the car stress tests and committing to working with this continued flexibility. Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from New Mexico, Mr. Pierce.
Thank you, Mr. Chairman. Thank you, Chairman Yellen, for being here. I just want to kind of catch up now. The gentlelady from New York had mentioned the problems in Puerto Rico. If you were to just summarize those in a phrase, basically, what's the root of the problem there?
I think deep-seated structural problems pertaining to Puerto Rico's fundamental economic situation that have given rise and exacerbated fiscal problems. Those
Okay.
who've looked.
All right, thanks. Now, when I'm looking back through through the 2008 crisis, I noticed that your balance sheet jumped from about $900 billion to 2.2 or something like that. What was the reason your balance sheet jumped during that period of time?
Primarily because we engaged in a program of purchasing long-term assets, both U.S. Treasury securities.
Sure, you
and
got assets from the banks who were having problems and kind of stabilized the banks, so you built.
No, we didn't. We didn't buy assets from the banks.
You bought assets from maybe Fannie or somebody. You bought MBS, right? You had mortgage-backed securities that you're purchasing that might have been toxic.
Well, I don't know that they were toxic. They were, they were put in receivership by the U.S. government. And
the general perception is they were toxic.
Okay,
all right, that's fine. Now, we were treated to Mr. Liu testifying to us a couple of days ago, and he identified in his testimony that he's required as the head of the FSOC committee to identify and respond to emerging threats to U.S. financial stability. Now, I pointed out to him that one of the doves on low interest rates, Mr. Rosengren, came out with his statement on the 21st in the Wall Street Journal saying, I think we need to rethink that there's a cost to full employment, basically. So, and he's talking about bubbling prices that might be caused by easy money. And so my question to Mr. Liu is, have the two of you ever talked that maybe one of the emerging threats to financial stability might be the easy money policy?
Well,
y'all haven't had a discussion, or you have?
We do discuss threats to financial stability.
About
we monitor
your easy
them
money policy.
closely.
Have you specifically talked about that? If he's going to identify it, he ought to identify the easy money policy. That's not coming from me. That's coming from the guy that's most often on the side of easy money.
President Rosengren has singled out commercial real estate as an area that he's concerned with, and
he says that easy money policies could be letting markets get out of hand. That sounds a little bit broader than REITs. Easy money policies could be letting markets get out of hand.
Well,
now,
there is the possibility that in a world of very low interest rates that investors will search for yield and take on additional risks. And we're very much aware of that. And
so we got a difference of opinion among board members. But then you get something like Virtu says we're going to stay out of the bond market completely because it's hard to price the assets.
Because what?
Virtu, the largest e-trader, signaling that his company is going to stay away from many securities because the underlying assets are hard to trade, citing the volatility of the trades, the inability to sell or trade, hedge the positions.
What is he talking about, corporate bonds or what?
In my opinion, maybe the bond market overall. And so it just looks like that things aren't quite as stable. Maybe there are underlying problems. Maybe there are bubble prices. And remember that the housing market began as a bubble problem, stimulated by government policy. And so to have everybody sort of looking the other way and saying everything is good, well, and then I look at your asset, you typically increase. I just look the fact that your balance sheet is now up to $4 trillion so you've almost doubled in the last 4 or 5 years. So you're continuing to buy something. And generally, if the market, and then I look at the debt. So Puerto Rico has got a roughly 76% debt to GDP ratio, and ours is 1-to-1. I'm sorry, but I think somebody ought to be talking about stability of the financial market in the United States because it looks desperately unstable. Thank you, Mr. Chairman. Appreciate your indulgence.
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Green, ranking member of our Oversight and Investigation Subcommittee.
Thank you, Mr. Chairman. Thank you, also, ranking member. Madam Chair, thank you for being here today. I believe history will be kind to you, as well as to Chairman Bernanke. What you did was extraordinary in a time of great crisis. And I just don't believe those who look back, those who look through the vista of time, I don't believe that they will see these as unkind, unfair, unwanted, or imprudent things. I think that they will judge you well, and you will be treated very well by history. Now, just a few things. I'm going to do my best to stay away from Wells Fargo. But I must tell you, it's difficult. Simply because, for one reason, if I may just mention this one, the $185 million in penalties is, according to some standards, about 3 days of profits. So this becomes a line item under the cost of doing business. So it's hard. I have some other things, but first let me do this. Let me just discuss with you the whole notion of too big to fail. Madam Chair, there's a bit of doublespeak taking place, because a good many people, when they speak of too big to fail, they mean that there will never be another bank that will fail, as opposed to what I believe most people understand the case to be, not have a bank that's so big that when it fails, it creates misery throughout the economic order. That's what we're talking about. It can fail. We'll put it out of its misery without it creating economic misery. That's what too big to fail is all about. That's what Dodd-Frank does.
Yes.
We haven't finished Dodd-Frank yet. We're still implementing aspects of it. But too big to fail is addressed in Dodd-Frank, and it's addressed in a very profound way. The living wills. That helps us to understand how to put these big institutions out of their misery. Dodd-Frank allows us to separate them if we need to and eviscerate them if necessary. So too big to fail is all about winding down these big AIGs of the world without them taking the economic order with them. I'd like to make a point, if I may, before you respond, to the question of community banks. Madam Chair, the big banks have hijacked the term community bank. They've hijacked this term. You and I understand that most banks in this country are under $1 billion. Most of them, probably 89% thereabout. Under $1 billion. Well, the big banks have concluded that you can be a $50 billion bank, a $100 billion bank, and still be a community bank. Therein lies the problem. Because when we make efforts to help the community bank, which are smaller banks, the big banks step in and they want all of the benefits that we would accord the smaller banks, the real community banks, a bit more doublespeak, the real community banks, they want those benefits. I applaud you for what you're looking at. I've read your statement, and you want to do something about this, an 18-month examination cycle. Look, there are people in Congress who'd like to help community banks, but we cannot do it at the risk of bringing in the big institutions who would benefit from it to the detriment of what we've been trying to do in Dodd-Frank. So I'm sharing these thoughts with you because I honestly believe that you have some great insight into these things. But my question has to do with something else. Here's my question. Given what we've done with the QE and all of the tools that you've utilized, how important is it for us to have some investments in infrastructure? Both presidential candidates have talked about it. Interest rates are exceedingly low at this time. How important is it for us to invest in infrastructure? Or maybe I should put it another way. Would infrastructure investments be helpful in promoting sound economic growth? I welcome your answer.
Well, I guess my perspective is that we've had very disappointing pace of growth in the U.S. economy, and productivity growth, the growth in output per worker has been exceptionally slow, 0.5% per year for the last 5 years, maybe twice that over the last decade, but low in historical terms. And that's critical to living standards, and investments of all sorts, I think, are essential to raise growth and promote improved living standards for Americans in the years to come.
Time of the gentleman has expired. The chair now recognizes the gentleman from South Carolina, Mr. Mulvaney.
Chair Yellen, I've got a couple of questions that are consistent with the hearing. Almost all of them are regulatory, but Mr. Naugebauer just actually handed me one that's monetary policy, so I want to ask one very brief question about that, which is there's been some attention in the last few months about the recent decision by the Bank of Japan to start purchasing equities. And my question to you is fairly simple. Is the United States Federal Reserve looking at the possibility of adding the purchase of equities to its toolbox as it looks at monetary policy?
Well, the Federal Reserve is not permitted to purchase equities. We can only purchase U.S. Treasuries and agency securities. I did mention in a speech in Jackson Hole, though, where I discussed longer-term issues and difficulties we could have in providing adequate monetary policy accommodation, maybe somewhere in the future down the line, that this is the kind of thing that Congress might consider, but if you were to do so, it's not something that the Federal Reserve is asking for, and
it would take a change in the law to do that, is what you're saying.
It would take a change in the law, and there would certainly be
Let's move on to the regulatory questions. I appreciate that. Thank you for straightening that out. Earlier, Mr. Neugebauer and Mr. Lucas both asked you about the proposed changes on the ways that you want to regulate commodities